Hey, this is Sasha. Thanks for joining me in this week's video. And what I want to share with you today in this episode is the double diagonal and why it's the most flexible option strategy out there. So stay tuned. I'm going to show you some examples here as well as some things on paper. All right, so if you've been trading the iron condor, maybe some butterflies, maybe some calendars in the past, but still haven't touched the diagonals, or maybe you're just brand new to trading options, I want to share with you some insight that'll open up your mind to how flexible the double diagonal strategy is. And with a lot of the other strategies, you can tweak them, you can move them a little left, move them a little right, a little bullish, a little bearish. But there's a lot less flexibility than the double diagonal. So this is what we're going to cover in this video. And one of the reasons we're doing this is taking a look at some of the things that we cover in our upcoming course, which is the Options Mastery Diagonals course. Now, this course right now is on sale and on promotion. So if you want to go ahead and get the course, we have a sale going on with a coupon code that's right on the website. And you can get this course by going to the tradersfly.com website. Once you're there, scroll down. There's going to be an image there, logo, as well as a Learn More button. And it'll take you right there to the ordering page. Now, this course is packed with a ton of modules, 11 plus hours so far, and we're going to dig deep into the diagonals. So looking at portfolio breakdown, how calendars are similar versus puts and calls using diagonals, and a lot of Greeks, understanding the Greeks of Delta, Gamma, Theta, Vega, how they work together. We're going to take a look at why this is the most flexible strategy, which is really what we're going to cover here right now in shorter detail. We'll look at why diagonals are great for pullbacks. We'll look at rotations, how much rotation to give, how to put these positions on when the VIX is low and high. So much more. If you're interested and serious about getting this course, go to our website, learn.com, and you can go there from that homepage. You can see the diagonals image, or if you like going to our free website at tradersfly.com, you can just head on over there and it'll be right there on the front page as well. Links will also be in the description below. Anyways, let's get things started with this session. And I really want to share with you why this is one of the most flexible strategies out there. It is a little bit more advanced, and it is a little bit more of a tricky to really grasp the concept. So if you're brand new, definitely watch some of the older videos that we have on maybe iron condors, basic vertical spreads, that kind of thing, because diagonals start getting a little more tricky as you start manipulating some things. And that's what we're going to do today. So taking a look at diagonals and really why they're the most flexible strategy is when it comes to a lot of positions, what you can do is, let's just take iron condor, for example. With an iron condor, you could position it a little bit more in the center where this is your price. So here's our strike prices. Here's the profit and loss that we would make. And we could position it to be a little bit more bullish, a little bit more bearish. So we can move it left and right. We can also skew it to where, hey, we have a little less risk on the upside by reducing the contract amount. So here I might sell 5 contracts on the left on the put side, and I might only sell 1 or 2 on the right side, or the call side. So this would be our puts over here. This would be our calls on this side. And that could be unbalanced. But what you're doing here is you're really playing left or right, puts or calls. Now, the other thing that you can do here is manipulate the strike distance. So if this strike is at, let's just do it over here on this next one, we could do it from 110, and we can also do the strike something like this on our, well, then it would continue going here on our iron condor. So the strikes now go from 190 to about 110 or 120. So I could manipulate these strike differences where I might have only 10 points or I might have 30 points. But that's about it. The problem with this, or maybe not the problem, but the issues that you may have is you can't manipulate the Vega. And with the diagonals, you can. You can do it quite a bit. So let me show you how that really works and what additional things you can do with diagonals. So if we have a diagonal here and we have a setup, well, I could make it fairly bullish. I could make it lightly bullish. And because I have this in split months, right, I'm selling 1, this could be 30 days out, and I'm buying 1, which could be 60 days out for protection, I could also go ahead and compress this. So I could compress that time. And I could go 1 that's selling 30 and buying 1 that's maybe 37. So now with that difference, I could actually convert this into a negative vega. So you're probably asking, so can diagonals be positive vega and negative vega, you might be wondering? And the answer is yes. Yes, they can be. And I'll share that example with you. But ultimately, the big difference here is not only do I have width and spread that I can do, manipulate the price, I could also manipulate the rotation. So I could rotate it much more, I could rotate it less, I could go left or right, just like manipulating the strikes with an iron condor, but I could also manipulate the vegas because I have the difference in months, such as January and February. Sell one in January, buy one in February, but I could do it even tighter than that. And that's what will allow you to have positive or negative vega. So let me show you on screen here how this ultimately works. So if we go here on a Russell example, so here we have a basic diagonal. Now you could say, okay, the Russell, whether it's going up or down, you might say, hey, I'm interested in this Russell, could be a little bit non-directional. I want to go ahead and start rotating this position. So this is, again, basic single diagonal. We're going to get into the double diagonal right in a minute. So I could go ahead and look at my strikes here before I put them on. And when I look at this, I have the 49 days and the 84 days. This is kind of the standard, the difference, because you're doing the Mays and the Junes. It's the next month forward. So you sell the Mays, you buy the Junes. So if we start with a calendar position right here, and we go with, let's just say I buy a calendar. We might be wondering, why am I starting with a calendar? Well, it's the diagonal is kind of a baseline to a calendar. So we start with the calendar, okay? And you can see with the calendar, I have the May I'm selling, and I'll buy the Junes. And for that, I would pay $11.20, which is multiply that times 100 at the $11.60 strike price. This is a balanced position in the sense of both strikes are the same, May and June, the one I'm selling and the one I'm buying. But to go ahead and convert this to a diagonal, I'll switch this to a custom field. And now what I can do is manipulate the strikes. So check this out. I could go ahead and switch that to an 1150, and now I got a little bit of a bullish direction. And I could go to 1130 on my long, and now I've got even more bullish position. I could go to 1110, and I'm even more bullish. And you can see with this rotation, I could just do it incremental. I don't have to do big rotations. And what happens if, well, I don't have enough space to the downside? Well, look, I could also move this left and right. So I could take this thing and move it to the left, meaning lower prices, or I could move it to the right and get, you know, even more directional. So let's see how this would work. So I'll go ahead and just duplicate this trade. So we'll go ahead and back this thing up. I'll go to the 1,000 and let's say 1080, and let's see how that looks. So here you can see now I've backed it up. Now, yes, you make less profit, less money from that position, but you can see now I've got more room on that downside. So I could do something like this. I could do something like this where it's more right at the short strike, or I could go ahead and do something even further up where I'm much more bullish, and I'll just bring this forward, and let's just go even more forward where it's a little more out of the money, and this will be a lot more of a bullish position. Again, maybe the market sold off in a big way, or maybe you're just bullish on a stock. So now you're going and you're shifting these to way out of the money strikes. And now you can see right here, I've got a position that's a little bit more like this. So that's kind of amazing, right? All these different things that you could do. Now, beyond that, you can also go ahead and switch these dates. So I could sell one in May, but I could also buy one in June. But now what if I go, instead of June, what if I go to, let's go to a normal position like this one. I'll go to the July. So could I go further out? Yeah, absolutely. So I could go to the July. It'll, of course, manipulate your graph a little bit further, but you can go further out. I could go to August. And again, you can see that effect. And this will affect my delta, gammas, and thetas, and everything there beyond. Now, what's interesting about this spread in these positions is when you combine it with another diagonal, you've got the puts and the call side. Now you've got a double diagonal. Now this double diagonal, in theory, typically you're positive vega. Why are you positive vega? Well, you're positive vega because you're technically buying more puts and calls, time premium or time value, then you're selling, because you're selling the first month 30 days out and you're buying the next month, which could be 60 days out. So you actually have more volatility that you've purchased. So this gives you a positive vega, which cushions you if stock prices go down. Not a lot, but a little bit. It cushions you compared to other positions like an iron condor or a butterfly. Now, the thing with these double diagonals is I could make them positive vega or negative vega. And you might wonder, how would I do that? Well, let me show you an example right here that's a negative vega example. And this, you can see, is also a double diagonal, but it's negative vega. Now, how did that work out? Well, if I zoom in on the contracts, what I did was tighten up the distance between my short and my long. So I went ahead and have the April 24th that I'm selling and the April 30th that I'm buying. So here, if I look at this and I look at the contracts, April 24th and the April 30th. So you can see it's about 7 days apart. So they're about a week apart on the difference on time. And because of this, it allows me to compress the difference of the volatility, making it kind of a really hybrid position. So if I want more vega, I could have went ahead and bought something further out. If I want less vega, I could do something in the middle. And if I want even less vega, I could do something very tight. It's almost getting close to an iron condor kind of position. So with that being said, let's kind of zoom back and just manipulate this for a second and just look at the Greeks. And you can see right here, what I've done is I've got a -6 vega. And if I go with, let's say further out, let's say May 8th, and I take this one also to May 8th, which is our protection, now I've converted it to a positive vega, you can see. And this is the flexibility behind these double diagonals, is I could do positive vega like this, or I could tighten it up and go here, April 30th, and now I've got a negative vega. And what's great about this is as prices go up, you benefit from the short vega, but as prices go down, and once you get kind of outside your range, kind of right over here, you're now actually positive vega, which means you get cushioned as prices go down after you kind of are getting close to that short strike. So think about that. Is this strategy kind of adjusts and adapts based on market conditions? Again, it's not foolproof. It's not, it's not an ATM machine where you just put it on and forget about it. But what I'm saying is that this strategy is very flexible to the movements in relationship to the volatility and the way that you can set it up. By manipulating the strikes, by manipulating the dates, manipulating the contract numbers or the amount. If you go ahead and put 2 or 3 contracts on one side, let's say I go ahead and put 3 contracts on one side and 2 on the other, now I can also manipulate those factors as well, my delta, gamma, theta, and vega. And that's why this strategy becomes extremely flexible for just about any kind of market conditions. So anyways, I want to share with you this tidbit. Really, it's some of the things that we go over in our course, in our diagonal series. Definitely check this course out if you're interested in trading options and you want to take your education and go deeper into it. Go to our website at tradersfly.com. Once you're there, scroll just a section down and you'll see the diagonals course. You can hit the learn more button and it'll take you right to that page. And for the moment, we're doing the coupon code and you can go ahead and get that course at a discount. And there's tons and tons of modules, and we're doing trade examples that we're finishing up, and we will be doing a webinar on it probably about a month after the sale ends. So stay tuned for that. We're going to cover a lot of questions and answers that you may have as well as you've went through the course. So if you're interested in this course, visit tradersfly.com or go ahead and click the link in the description below, and hope to see you there. Anyways, thank you so much for joining me. Remember to hit subscribe here by clicking the face icon if you're brand new to the channel, or go ahead and join our newsletter list by clicking the link right here. And then I will see you there for any good announcements, discounts, live webinar events and updates, and much more. Thanks again, and I will see you next time.